Hello everyone, in this video we're going to be going through the topic of step 3 of the 5-step process. Again, as I've said in the other videos, there's a particular order you should be watching these in. You should start with the overview of the 5-step process video, then do steps 1 and 2, then do step 3, and then there's a video on steps 4 and 5. Okay, that's the order you should be doing them in. Okay, step 3 gets its own video just because there's a lot of stuff going on in step 3. So step 3 is determine the transaction price. The transaction price is the amount of money or other consideration the company selling goods or services will receive. Okay, basically, so it's just essentially a lot of the times it's just the amount of cash the company will receive or other consideration, meaning, if they get stock or they get some sort of an asset, that's what the company is going to receive for selling goods or services. Many times it's easy to determine the transaction price, and such as when you buy a piece of candy from the store or you buy an iPad, right? It's just very straightforward. A lot of the time it just says the iPad is $500 or the piece of candy is $1, right? But in certain situations, we have issues, okay? 4 situations present issues for determining the transaction price. These are variable consideration, time value of money, non-cash consideration, and then volume discounts, cash discounts, and then coupons, okay? So we're gonna go through these 4 basically. The first one's definitely the longest, and then we're gonna go through a practice problem for each one of these 4 situations. So the first one is variable consideration. This is when the amount of consideration received by the company is dependent upon future events, okay? So examples of situations that have variable consideration are things such as volume discounts, rebates, construction contracts, etc., okay? So basically meaning that we're not sure exactly how much consideration we're gonna get as of the initial sale or whatever is going on. And so we have to try to determine how much revenue we're going to recognize. Okay, we have to come up with some estimate of what we're going to recognize because we don't know for certain exactly what's going to happen. Right? It's dependent upon a future event. So companies can use 2 approaches to estimate how much revenue to recognize. Okay. First is the expected value approach. This weights each possible amount by how likely the company is to receive that amount. Okay, this is used when company has many contracts with the same characteristics. Okay, so if you have many contracts with the same characteristics, you can potentially use this approach. Also, it's used when a company can identify a set number of amounts and probabilities for those amounts. All right, then we have the most likely amount approach, which uses only the amount the company is most likely to receive. So this is used when the company will receive one of 2 possible outcomes. Again, when we use these, so these sub-bullet points, you don't necessarily need to memorize those or anything. Generally, the problem is just going to tell you use expected value, use the most likely amount approach, use one of those 2 approaches, okay? And so we just need to know how to do those. And we will look at a problem of how to work through those in just a minute, okay? Companies may only recognize revenue using the variable consideration approach if they are reasonably sure that they will receive the amount of the estimated revenue. Okay, so they can actually only recognize revenue using this variable consideration approach, meaning one of these 2 methods, if they are reasonably sure that they will receive the amount that they estimate. Okay, this means that the company must have experience with similar contracts and the amount can't be determined by something entirely out of the company's control. So, for example, if the amount of revenue is dependent upon a stock index or another similar measure, revenue would not be recognized until the amount of revenue is determined with absolute certainty. Okay, this basically means, if it was dependent on something that's completely outside of the company's control, right? The consumer price index, CPI, or some sort of the S&P 500, a stock index, okay? The company itself has no control of those situations, okay? So they must have a lot of experience with other contracts to actually be able to recognize revenue using this approach, okay? Also, they have to be reasonably sure that they're going to receive that amount, okay? The way they're going to be reasonably sure is that they have the experience, okay? That's basically the first part for variable consideration. Now we're going to move on to the next 3, which are much quicker, okay? The first one we have is time value of money there at the top. Time value of money. Companies must record revenue equal to the present value of the consideration received for the product or service sold. So, for example, if a company receives a notes receivable for a piece of equipment, it records revenue at the present value of the note. Okay, again, this is just time value of money concepts. We're trying to record revenue at the current cash equivalent cost of the product that would be sold. Okay, in this case, piece of equipment, and basically saying current cash equivalent cost. What does that mean? It means the amount that we have to pay in cash today to get this product. Right? That would be the present value of the note. Okay, we've covered that a couple of times now, so that's basically what the present value represents. The non-cash consideration, companies must record revenue equal to the fair value of the consideration given for the product or service sold. If a company receives common stock for accounting services, it records revenue at the fair value of the stock. Finally, volume discounts, cash discounts, and coupons. Companies reduce the amount of revenue recorded for any discounts granted or coupons redeemed. Okay, so now let's just go ahead and walk through some problems here. Let's make sure that we have everything showing. All right, perfect. So the first one we're doing is variable consideration. Again, there's a lot of information here. It's not that hard of a concept to do. It's just you have to read through this and fight through all the information. And then we can work. Again, you can see the solution here at the bottom. It's very easy. It's actually not that hard at all. It's just you have to walk through these problems a couple of times, and there are a lot of words in them generally. But once you've read through it, you're like, oh, okay, we do this and that, and it's actually relatively straightforward. Okay. ABC Company sells and installs flooring. On December 31 of 2017, the company received an order from XYZ Company to install 50,000 square feet of wood flooring at XYZ Company's new headquarters. The contract is written such that ABC will receive more compensation the faster it completes the installation. If ABC completes the project by January 31, it will receive $1 million. If it completes 2018, if it completes the project by February 2018, it will receive $750. If they do it by March 31st, they get $600. If they do it after March 31st, they get $500. ABC believes there's a 50% chance it'll be done by January, 20% by February, 20% by March, and then 10% after March. Additionally, the company had numerous other contracts of a similar nature and has had numerous other contracts of a similar nature in the past. That's just telling you that the company can use the variable consideration approach because, again, they have these similar contracts in the past, which means that they can get a reasonable estimate of the amount of revenue, so that way they can go ahead and recognize revenue using either the expected value or the most likely amount approach. In this problem, we're actually going to do both expected value and most likely amount approach. We're going to do both of the approaches just so that way we can get practice with both. So now it says, determine the amount of revenue ABC will record if you use the expected value approach, then determine the amount of revenue it will record using the most likely value approach. Okay, so again, what we want to do is we want to just say, okay, what do we do for expected value? What we do for expected value basically is what we could do at the top here is we could just set up a little chart, okay? So this is after March. Okay, so it's January, February, March, and then after March. And then we're going to write the amount that we would receive, and then we're going to write the probability that we're going to get that, okay? So again, January was $1 million. February is $750. If we complete it by February, we get it $750. If we complete it by March, we get $600. And then if we complete it after March, we only get $500,000. Okay, then the probabilities are 50% chance done by January, 20% by February, 20% by March, and then 10% after March. Okay, all we're going to do, again, it says expected value, weights each possible amount by how likely the company is to receive that amount. This is the amount. This is how likely they are to receive the amount. All we're going to do is multiply. We're going to multiply the amounts times the probability that we're going to receive that amount. So again, we're doing 1 million times 50%, 750 times 20, 600 times 20, 500 times 10. Okay, and we can see that in this solution right here. We just do all that math out, and that gives us $820,000, okay? So we just take the amount that we're going to receive, that we think we'll receive, we multiply that, we weight that by the likelihood that we will receive that specific amount, and then that gives us, if we do that for all the outcomes, that gives us a weighted value, an expected weighted average, okay? And that's the amount of revenue we would recognize under the expected value approach. Then, under the most likely amount approach, we recognize $1 million because the most likely amount is $1 million. It's 50% likely that we would get that amount, so we just pick the one that has basically the highest probability for the most likely amount approach, okay? So basically that's how we do this. It's not too bad on the actual calculations, but you just have to fight through the actual text of the problem, and then you might want to prepare a chart like this, or if you've done these a few times, you can kind of just write it out like this. It doesn't make a difference. But yeah, that's basically variable consideration. Now we're going to do a time value money problem. The rest of these problems are relatively quick. So let's see. So we don't necessarily need the other notes here. Okay. So we have ABC Company. They're in the business of selling large equipment and machinery. On January 1 of 2018, the company sold a piece of equipment to Jim, one of the company's most loyal customers. Jim gave ABC a 2-year, $50,000, 10% note in exchange for the equipment. The appropriate market rate for a note of this nature is 12%. Prepare the entry to record the transaction for ABC. Okay, so what we want to do is that we want to record revenue at the present value of this note that we receive, right? That's what we said in our notes, and that's what we want to do. Record revenue at the present value of the note. Okay, so our N would be 2 years. Interest rate is 12. Again, we use the market rate. Present value we're solving for. Payment is $5,000. It's just $50,000 times 10%. Future value is $50,000. That's the future value of the note. We get present value of $48,310. So we record revenue of $48,310. Then we would debit notes receivable because we're receiving an asset. We're receiving a notes receivable. And then the credit to make up the difference is going to be to discount a notes receivable to show the notes receivable at its present carrying value of $48,310. And then also just to make sure that we have a reconciliation between debits and credits, right? We can't have more debits than credits, okay? So again, we record revenue at the fair value of the note, which is the present value of the note. We always put the note on at the full value, and then we record a discount to account for the difference. If there was, and then yeah, so that's basically the time value of money problem. Then we have a non-cash consideration problem. Again, we want to record these. We want to record revenue at the fair value of what we receive. So now XYZ Company is a non-cash accounting firm that is an accounting firm that provides many different services to customers. On March 20th, 2018, the company provided accounting services to Jake. Jake gave XYZ $10,000 of stock, right? Stock worth $10,000 for the services. So now I have to prepare the journal entry. Again, we're just going to record revenue for the fair value, which is $10,000, okay? And then we receive an equity investment of $10,000. So we just debit equity investment for 10, credit service revenue for 10. Okay, we're recording revenue for the fair value of the services, and then we put the asset on the books. That one's relatively straightforward. Then we have one final problem. Obviously, we're going through the last examples a little quick because they're truthfully not that complicated. First one we went through a little bit more slowly just because it was more complicated. Okay, this one relatively straightforward as well. ABC Company gives its customers a 2% discount. So this is volume discounts, cash discounts, and coupons. ABC gives its customers 2% discount if they purchase more than $500,000 of goods during the year. Every year for the past 5 years, James has purchased $2 million worth of goods from ABC. On January 15th, 2018, James purchases $350,000 of goods from ABC. So it says prepare the entry to record the sale to James on January 15th of 2018. So again, if we remember back from our packet, it says that when we record revenue, we need to record it net of the amount of the discount that the customers are going to take, right? Because we're not actually going to receive $350,000 of goods, of cash, if James hits this $500,000 threshold. Okay, then he gets a 2% discount, right? So we actually would only receive $350,000 times 98%, right? We'd actually only receive $343,000, assuming that Jake hits his $500,000 threshold at some point during the year, okay? So every year for the past 5 years, he's purchased well over $500,000. He's purchased $2 million worth of goods. Okay, so it seems like this year, there's a very likely chance he's going to hit the $500,000 threshold, and we're going to have to give him a 2% volume discount. Okay, so because, and not only that, but he purchased $350,000 in January, so the chance he's not going to hit $500,000 is very low, right? So we want to prepare the entry to record the sale to James. Okay, so what we should do is we should debit accounts receivable, credit sales revenue for $343 because that's net of the sales discount, or sorry, the volume discount in this case, actually a volume discount. Okay, it's net of the volume discount. We should record it net of the volume discount because we're expecting to only get that much, right? Realistically, we're only going to get $343,000 most likely because he's going to hit this threshold of $500,000. We're giving him a 2% volume discount. Okay, so then we have two situations. If James buys at least $500,000 of goods, we don't adjust this because that would be correct, right, as we just talked about. However, if he buys less than $500,000 worth of goods, they make the following entry to adjust the revenue. We increase our accounts receivable by $7,000 and we increase our sales revenue by $7,000 because in that case, he would not receive the 2% discount. So now we get to record $350,000 times 2%. We get to record $7,000 more of revenue, okay? Because again, we assumed at the beginning he would get he would hit the threshold, so we don't record that $7,000. We just assume that we're not going to get that money because he's going to get the discount, which results in less revenue and less accounts receivable and ultimately less cash for us. But if he doesn't hit the threshold, we record more accounts receivable, we record more sales revenue for that 2% discount that we didn't record before on the full $350,000 of goods. Okay, so that is the end of this video, and I hope that that was helpful.